I'm so excited to kickstart this year's lecture series on value investing. I'd like to thank Terrence Chong and Ting Hing for their fabulous organizational skills. It's just terrific that we've gotten so much interest in the lecture series and the competition. I'd also like to take a second to thank my partners in crime on this effort. About 4 years ago, Aubrey Lee and Terry Falk, who are both great investors in their own right, worked with me to come up with the idea of a lecture series at Chinese University of Hong Kong. And I greatly appreciate their support in helping me craft with Terrence Chong the vision for this speaker series. The lineup this year is fantastic. I'm delighted to be here as the first speaker, but you also have Mr. Che Shanghai, who is the founder and chairman of Value Partners, which beyond being a public company in Hong Kong, Value Partners is a large asset manager around Asia. And certainly Shanghai was one of the pioneers of value investing in Asia. And then the second one we have is Ted Seides. Ted is the founder of Capital Allocators, the famous podcast, a very successful podcast in ecosystems. If you haven't gone on to capitalallocators.org and listened to some of the podcasts, I really encourage you to do that. He has now somewhere around 230 podcast episodes with the really famous who's who of capital allocation here in the United States and around the world. In March, Ted is releasing his second book called Capital Allocators: How the Successful Allocate Capital in the Large Asset Allocators Around the World. His book is going to be really a how-to book, and I think it's going to be massively successful. And I encourage all of you to go on there and start looking through the podcasts, and you'll find some of the great voices in the money management business there. And then lastly, we have Joseph Yam, former head of the HKMA in Hong Kong. For those of us who have been in Hong Kong a long time, Joseph has his fingerprints on all the successful development of Hong Kong as a financial center. And I think we all owe him a debt of gratitude for his involvement in the development of the stock exchange and the financial system in Hong Kong. And I think it's be a great opportunity for you to learn more about the building blocks of a really strong financial center. So this year's stock picking competition, first prize is 60,000 Hong Kong dollars. And then there's money for both second and third place. I understand there are 86 teams, so it's a big competition this year, but I encourage all of you to start thinking about stocks that you can promote in the competition. I was really, really impressed as a judge last year in going through those submissions. So now, before I start, I'd also like to just make a couple of other small comments. And this was more about just the value of this work on trying to learn how to invest properly. The skill set of learning to invest in public companies is never going away. Okay, the more we read about ETFs, index funds, and whatnot, the more the world is going to need serious people who really think through how to allocate capital correctly by putting that capital in the very best public companies. And so it is not going away. This industry can offer you a fantastic career. And for the last 40 years, I've been a stock picker. That's what I do. I pick stocks. But I can tell you in the next 40 years, your generation will still be picking stocks. And you can't say the same thing about a lot of professions, but you can say it about this. So the time you spend in Professor Chong's class, the time you spend at these lectures, the time you spend with your team trying to figure out how you're going to promote and win a competition, or the time you spend just reading at your leisure, all of that is extremely well spent. Now, I'll tell you another story here just before we begin, which is my dad used to come home and he ran what we call today a multifamily office. And Dad came home every night and he'd say, wow, the greatest thing about this business is I get to learn new things every single day. And again, there aren't many professions where you can learn new things, new exciting things every single day. And so I really encourage you to stay after this, and there's a bright future for you in this business. The other thing, which was a little more on a personal thing, I know you students have had a really rough go of it the last couple of years with protests and COVID. And I have great admiration for you that you stick with it and keep trying to move forward. The times have been, I wrote down, difficult, challenging, unpredictable for so many people, and yet you persevered, and you will be stronger for it. But really what I wanted to say is now you're seeing firsthand the importance of securing a margin of safety, because events like the last 2 years that we've lived through in Hong Kong can happen. And so, which is this concept of margin of safety is so central to learning how to invest properly. And we're really going to talk about that today. So let me talk. I'm going to share my screen with you, and we will start off. I know it doesn't seem to be moving. Just give me a second here. Yep. Oh, there it's going. Okay, so we're going to start out with a quote. When I started working in New York in the early 80s as a research analyst in a brokerage house, my dad sent this over to me, and it's from Will Rogers, a famous commentator on American society. And he said, buy some stocks and wait for them to go up and then sell them. If they don't go up, don't buy them. And it was my father's way of saying that this can be, if you really do fundamental analysis, this can be a very simple business. But I'll share another, no, it's still not going here for me. Just give me a second here, a little.
You'll want to click probably, then it'll go back with this one, forward though. You should just go back forward.
Yeah.
If it doesn't, then click it.
Just click it. So, okay, so this was a comic that was in the New Yorker magazine in 1974. For those of you who don't know the history of the stock market, 1973-74 was a bear market equivalent to 97-98 in Hong Kong. It was brutal. And here you have a picture of a research analyst hiding under his desk with an irate client and an office manager that used to exist. That role probably doesn't exist anymore. But he says, you'll be very sorry to miss you, but I can assure you at the time we all considered it a stock with strong growth possibilities. And this was the demise of what we call the Nifty 50, where these growth stocks went down over 90% in 73, 74. And my boss, who was a very classy guy, after he had certainly diced and quartered his clients, he had the style to send this out as a Christmas card to everybody. And I would think that most of his clients really didn't think that was all that funny. But we'll start out talking about the Overlook model. And this is a model that's been at the core of my investment work in Asia for the past 29.5 years. This is what's driven our success. And what we talk about here are 6 interlocking components that we'll walk through. This really is the core of our work. And there's some lessons here as you think about not only investing, but also think about running a fund management business someday in the future. These are really critical lessons that are important for you to learn. So first of all, we have a focused and independent structure. We have one fund, no side accounts, no special deal. We have a portfolio of 20 to 22 holdings. You don't need 75 stocks in your portfolio. 20 to 22 is all you need. We have a small team where it's incentivized by ownership, where the ownership of Overlook stays within the 4 walls of Overlook. And we all have long-term compensation to align ourselves with our investors. And we don't have any side deals, no special deals, no lousy business practices that put me in a position of conflict with limited partners. And this focused and independent structure has been a major contributor to our success. Then we have a second component is a proven investment philosophy. If you look here, a superior business, management with integrity, bargain valuation, and long-term time horizon. This was in my first PowerPoint presentation 29 years ago. But if you look at it, this is what makes a great stock. A superior business, which we're going to come back to and talk about. So it's the quality of the business. Then we talk about the quality of the management. Then we talk about the quality of the valuation. And then we talk about the quality of the long-term opportunity for us as investors. Those four components is what makes a great stock pick. Okay? This is specific. Our specific investment philosophy is rigid and demanding, yet flexible. It hasn't said to us we've got to be in 100% cash at any time in our past. But it's really what you have to understand as students. It's the confluence of those four concepts. That's what creates the value. And so at Overlook, what we do is we just execute this investment philosophy. And we don't need to invent anything new. We just execute it day to day. Then the next two slides are about how I think about a fund management company. And really what we're looking at here is almost like two sides of your brain. On the one side, you have the soft skills, and on the other side, you have the hard skills. And so when we talk about the soft skills, we're talking about an organization whose common goal is just to invest correctly in Asia, free of conflict of interest. Just do it correctly. And when you do it correctly for your clients are going to stay with you. And that's duration. But we also need a culture at Overlook. All these concepts here that we list, these philosophies, these are things that all of us share at Overlook. Value investing, engagement with management, capital weighted returns, long-term contrarianism, aligned incentives. These are things that we all share. And we find that if you don't share these at Overlook, well, then eventually we ask you to leave and clean out your desk, and we change the lock after you leave. Because this is the glue that holds us together as a team. And you don't necessarily have to follow exactly this, but you have to find your cultural DNA as an investor. What are the philosophies that you really believe in? Then on the other side, you have what we call the Overlook tools. These are a whole series of apps that we use. They reside on our computer. The disciplines, procedures, and processes that we use day to day in our work. It's forming the basis of our work as we analyze companies. And these tools cover a whole range, and we'll come back to some of them later in the talk, but they cover a whole range of things, from simple things like monitoring the list of stocks that are hitting new lows. They cover also our spreadsheet that we use to analyze our company, that gives us the information that we want, not the information that Goldman Sachs or UBS thinks we want. Okay, it's giving us the things that we believe are the real drivers that we can all read very efficiently, customized yet standardized. It's a very subtle match there. So when I want to look at the cash flow statement, I know exactly where to go to, but the cash flow statement will be adjusted for each specific business. So customized yet tailored. And then we go on. We have equations for pricing power, equations for capital intensity, equations for how we grade our management teams. How do we score risk? We find that times that people get very scared of events, and we can go in and we can score the portfolio for that specific risk. And then we go on where we have an app or a tool which tells us how to behave in bear markets. What do we do? So these tools have all been developed over time. We introduce new tools every once in a while, and some stick around and some get kicked out. but they're all designed to give the people at Overlook what we feel is really important: a focus on profitability, cash flow, what are the real drivers in the business, an evaluation of management, the valuation, and the opportunities and the risks. And then we add on one additional tool that has been very fundamental to our work, which we call modern finance technology, MFT. This is the provision, and we have a hard definition of this. This is the provision of conflict-free and private advice to chairmen and CEOs of public companies on issues of corporate governance and capital management, with an objective of making better public companies. And there are a couple of things in there. Private and confidential, number one. So all our activism has all been done privately, between me and the chairman, between me and the CEO, or one of my colleagues, between those same people. And in that environment, we have found that we can speak very honestly and very frankly to executives about differences of opinion about how their public company is being run. And it's proven to be of enormous value to us. When companies say, yeah, Richard, I see what you're thinking. I see what you're talking about. Well, then we're seeing a real McCoy, a guy who's really running his public company for and on behalf of all shareholders. And that, when you can find those real McCoys, it's of enormous value to your funds that you manage. And then the fifth piece of the model is that we have an objective of delivering returns to the investors. It's a somewhat arcane concept in today's world, where so many asset managers are seeking to grow their assets under management. Size, we need size. We want more size. We want more funds, right? What we believe in is delivering returns to the investors, because if we can deliver the returns to the investors, they're going to stay with us. And if they stay with us, we're going to be able to do this amazing job for another decade, for another 2 decades, for another 3 decades. And that really is one of the great joys of life. And so when we set out to drive returns to the limited partners, we measure this by capital weighted returns, not time weighted returns. When you open up the newspaper and see an ad from an investment manager, what you see is the time weighted returns, where he selected a date, a beginning date and an end date, and said that his NAV per share compounded at some rate over that period of time. What capital weighted returns do is they measure the return for each individual investor during the period of time that they were an investor. And they measure the returns for the group as a whole. And research has showed that time-weighted returns generally outperform capital-weighted returns by upwards of 7 percentage points per year. So if a fund is saying that they're going to grow at 12%, what they're really delivering to their investor group is 5%. Peter Lynch, who was the most famous investor in the 1980s and 90s in the United States, put up tremendous numbers. And during that time, his investors lost money. And so what we've done at Overlook is we're purposely driving to capital weighted returns. And when you set out to do that, you do automatically a few things. The first thing is you control the growth of assets under management. So Professor Chong said we manage today about $6.5 billion. Well, we just returned $1 billion this month. And 3 years ago, we returned another $1 billion. And so we're trying to control the growth of our assets. We have a cap on subscription, which limits the inflow of money into the fund. And this has been absolutely essential. It's been the best business decision of my life. And so what you see when you look at our performance numbers is over 1, 3, 5, 10, 20, and almost 30 years, the capital weighted return and the time weighted return are almost identical. So we've eliminated that 7 percentage point discount. And that's why we have a backlog of investors who want to give us money. And when you adopt the cap, that's what you get. And there's a small community of people like us around the world. But I would suggest to you that all of them are controlling their growth of assets under management and have a big backlog of investors who want to give them money. And in the fund management business, that's the crown jewel. We also do things, no soft dollar brokerage, no employee trading, et cetera, et cetera. We've cut our fees 22 times in 29 years, all designed just to outlaw greed. And then lastly, the sixth piece is that we manage the partnership for bear markets. Bear markets are the critical time. You can't miss, you can't swing and miss at a bear market. And so there are a number of things you have to do in order to grab the value creation opportunity during bear markets. The first thing is when markets are hot, you don't take in new capital. Then when they begin to come down, you replace those investors with the people who are in your wait list. And then at that point, you've stabilized the capital of the fund, then you invest. And we have a saying at Overlook that we buy early and often. And you buy and they go down, you buy and they go down, they buy and you go down. But history has showed me that at the bottom, we don't buy very much. And I can tell you why, is that generally I've bought and they've gone down, I've bought and they've gone down, and I'm finally so angry and annoyed, I say they're not catching me again. And then on the first leg up of the bull market, which should be the easiest time to invest, we also haven't invested very much. And so it's actually predicated, you have to buy while the stocks are going down. And what you'll see is as you do that, once that thing turns, your stocks will outperform for 5 to 7 years. And you can see exactly that during in our performance history. So what we're saying here is we're not predicting bear markets. You don't want to run your fund management with an idea that you are predicting the unpredictable. But what you can do is you can prepare. And by preparing, what we're talking about here is putting a margin of safety into your portfolio. And we're going to talk about that in a second. So the results, this model that we've talked about here covers the really critical parts of a fund management business. Simple structure, an investment philosophy that works, clear objectives, long-term track record, and aligned incentives. And we've compounded our money for the investors at 14.3% compounded per year for 29 years. We've outperformed the benchmark by about 6.5 percentage points per year for 29 years. And from an inception of $30 million, we've created 6.8 billion US dollars of profits since inception. And so the profits are larger than the amount of money we manage today. And so we are really dedicated to this model. And we say at Overlook, don't mess with the model. And I think it can be a wonderful framework for all of you as you begin to go out and find what your investment philosophy is. It doesn't need to be this investment philosophy, but you've got to find your investment philosophy and then surround it with the business philosophies that we've talked about. And there you can see we've grown a multiplier. This is the power of compounding. So $1 million 30 years ago is now $50 million. And the spread between this and the index just keeps widening. So now I'm going to talk about the path, what we call the path to outperformance with value investing. And the goal of all of this is to give you the components that you can utilize to create a margin of safety. And as we talked about at the start, in Hong Kong, we've had protests, we've had COVIDs. What else are we having? Political disruption, right? And this is exactly why you utilize these 6 components to create that margin of safety. So the first thing here is this is top secret. This is really top secret. So here the pyramid reflects the universe of stocks that you and I can invest in. And at the bottom of the pyramid are most of the companies. Pretty mundane, marginal profitability, not particularly well managed, not managed for shareholders, need, capital raisings, cash flow negative, a lot of working capital, what we call low return on equity, high debt companies. And at the top of the pyramid are those few companies that generate extremely high returns on equity, have low debt, mostly net cash, that are really inordinately profitable. And if you can get your money in at the top of the pyramid and avoid putting your money in at the bottom of the pyramid, you cannot underperform the benchmark, which is the whole universe, with one exception, which is you pay the wrong price. If you pay reasonably the right price, let me get a drink of water. If you pay reasonably the right price, I don't believe you can underperform. I just don't believe it over time. And I think this has been the key to Overlook success, that over 29 years, we've spent most of our life in companies that are at the top of the pyramid. The second thing that we're going to talk about here is pricing power. Almost every successful investor that you talk to, somewhere in his discussion, will talk about the importance of pricing power. And about 12 years ago, I got sick of this because they say it, and every company says, oh, this company's got pricing power, or that company's got pricing power. I said, well, how do you define it? What is pricing power? So I wanted to stop the lecture here for a few minutes, and I want to pose a couple of questions to the students. And the question is, how do we measure pricing power? Why? And you can answer any of these questions that you like. Why should investors want pricing power? What are the components of pricing power? How do we quantify pricing power? Where is pricing power reflected on the income statement? And then how would you index a pricing power calculation? Now, I would love to hear comments from anybody in the audience. I would. But I can also tell you that all of you should take this screen and think about it at home. Because when you answer these questions and you really ponder these questions, you're going to gain some insights. So let's put it out there before I give examples of what I think are pricing power. Would anybody like to comment? And you can raise your hand and comment, or you can put a question in the chat and Ting Hing will manage that.
Yeah, we've got someone from the audience who would like to ask a question. I will take you off mute now.
Oh, hi. I believe that the pricing power can be measured by cash gross profit margin. So sometimes, even if the firm's revenue is high, if the cash gross profit margin that can be measured by EBITDA margin is high as well, then we can see that it has a relatively high pricing power. And I believe.
Go on.
Oh yeah. Just to add a little bit more, I believe that cash gross profit margin is an excellent measure because when you just look at the so normally depreciation values varies by countries, so it is relatively an objective measure to use cash gross profit margin.
Wow, fantastic! You get an A. Mr. Chen's getting an A. So I had one comeback for you. You mentioned cash gross profit margin, but you also mentioned EBITDA margin. How do you measure the difference between those two?
Okay. Can
you want to comment?
So yeah, I was muted for a second. So the key, I'm not sure what key difference is, but EBITDA itself doesn't include the interest and depreciation and amortization. So perhaps there is a difference in the calculation method in that terms.
Okay. Okay, you can answer that question by doing a little more thinking about it. I don't want to give away. I don't want to give away everything, right? But excellent observation. I commend you on that. Anybody else
Thank
like
you.
to comment?
I think we've got one more. Let me. Hembo Tian.
Hello, I'm Tian Hanbo, and I believe that a kind of bargaining power or pricing power is a company's attitude towards its supplier and buyers. Actually, I think for the suppliers, as if a company is powerful enough, like Apple and Tencent, we can see from its income statement that its inventory turnover days were substantially low, like 6 or 7 or so. That kind of inventory turnover was actually those companies forcing their suppliers into holding the parts and kind of gauges into their garage instead of the companies. So a low inventory turnover days could actually measure a strong bargaining power towards suppliers, and also for the buyers, and sales turnover days could be also utilized as a similar approach. So that's what I think bargaining power could be revealing from income statements.
Right. I don't disagree. You know, there's a great question that you should always ask companies, which is your top 5 customers make up what percent of your sales, and your top 5 suppliers make up what percent of your cost of goods sold, right? To see the competitive balance in that. So yes, as you go back to the earlier student's comment about the cash gross profit margin, and I can make a couple of comments on that in the next couple of slides, but then you dig deeper and you say, well, why do they have it? What is it? And so, yes, I would agree. Looking at the turnover of working capital relative to sales is important. So, good answer too. Anybody else?
We've got 2 more comments in the chat box. One from Jeff Pang. He says consistently high return on incremental invested capital. Would you like to elaborate a little bit more, Jeff? I can take you off mute.
Sorry, are you able to hear me?
Yeah,
We can hear you.
So I'll give you an example for this. Imagine, well, maybe a typical one is like these candies where you see them raising price every single year, but they don't really have to invest a lot into their facilities or whatever marketing stuff. And a more recent example would be Disney. If people have been to their parks, imagine 08, 09, they raised the ticket price to their theme parks, but that's not requiring any capex or investment. So if you look at the return on incremental investment, that probably tell you something when it comes to pricing power.
I agree, and look at that. What we're talking about here, with a high cash gross profit margin, a good working capital situation, minimal incremental return requirements for capex, all of those things are all the components of these companies up at the top of the pyramid. So you're not going to get any argument from me. When you actually try to measure return on incremental capex, that requires a really quiet time at your desk to really think that through carefully over a long period of time, because there'll be a lot more volatility in those numbers over short periods of time. So one of the tricks, as you think about something like Disney, would be look at their ratios on this over 30 years, and you can get those 30-year numbers. So that will really help you gain confidence. Whereas you can have 1 year where it might be a good number or a bad number, and that can fool you. Was there one more chat, Ting Hing? but good comment too. I commend you on that. You're muted.
Sorry. I think we've got one more comment from Stephen Wong. I will unmute you, Stephen. Just one second.
Hi, can you hear me?
Yep.
Yep, we can hear you.
Oh yeah, so I'm just adding on the cash gross profit margin versus EBITDA margin question that you raised. Is that I guess I mean by definition the only difference between these two is the operation cost, which is not being included. While I think cash gross profit margin is better because it doesn't take into account the function of scale. So if you imagine like in very bad times like 2008 or 2020 last year, you can look at a lot of manufacturing companies. Everyone, they have a decrease in gross profit margin or even EBITDA margin, but not every one of them really have a decrease in the cash gross profit margin because all the operation costs, including depreciation, they are a function of scale. And it doesn't, I mean, they can maintain a 30% or 40% margin to their clients, but at the same time, they have a decrease. You can see a decrease in margin just simply because of scale. So I think cash gross profit margin is a little bit better.
Yeah, and I would add when you take out your operating expenses, which is the difference, and depreciation for that matter, operating expenses aren't related to the pricing decision that the CEOs are making.
Yeah.
Yeah. So I'll go on. And we can come back to this, but those are all great answers. And I can tell you, I did a lecture at the Ben Graham School of Value Investing at the University of Western Ontario about 7 or 8 years ago. And when I asked about pricing power, those guys were flummoxed. So good for you guys to get this. All right, so I'm going to go on and I'll show you exactly. So I'm going to show you a couple of companies that, in my view, have pricing power. And so on the one hand, here's a business that most of you will know is Vitasoy, another company here called TSMC, which all of you should know as well. But you can see, despite growth, that they grew and they maintained very, very flat EBITDA margins. Now, we could have put in here cash gross profit margins, but it's a little bit my secret, and I don't like to talk publicly too much about it. But that's what you want to see. In particular, we've updated the TSMC slide, but I can tell you back in 2007, in September 2007, they were operating at 104% utilization. By January, they were operating at 32% utilization. And yet in Q3, Q4, Q1, the cash gross profit margin that we've been talking about was absolutely flat. And so despite this tremendous exodus of their customers, they didn't change their pricing policy. And so what we learned in 07, 08 was that this TSMC was the best high-tech company in Asia. And then about 5 years ago, we said, well, this was the best company in Asia. And now we say it's one of the best companies in the world. But you can track that back exactly to that experience in 07, 08, where despite volatility in their business, they held their cash gross profit margin. And so now we go to a couple other companies that don't have it. And you can see lots of growth in both cases, and yet their EBITDA margins dropping in both cases. And so it appears to me that both these companies are a little bit like a hamster on a treadmill. You know, they're spinning faster and faster and getting absolutely nowhere. And this goes to the weakness of their working capital situation, the weakness of their bargaining position, the weakness of their reinvestment of CapEx, because obviously they're investing for CapEx, but they're not getting anywhere. So I think you've got a good grasp of companies with pricing power. Now, the next thing is cash flow. This is another area where you get your margin of safety. But I ask analysts to leave the room if they are not specific about what type of cash flow they're talking about. Okay, there are 4 specific types of cash flows. So you can talk about it very simply. Net income plus depreciation plus non-cash items. Very simple. We can all calculate that. Okay, but then you add on cash flow after maintenance CapEx, which gets to the reinvestment issue. But this is a rather harder number to talk about because some executives don't even think about terms of maintenance CapEx. But both of those are important cash flow calculations. The next one is cash flow of the corporate structure. And I'll give you an example of that in the next slide. But this is the corporate structure that we're putting our money into is really important. Is it simple, clean, or do they have a lot of minority interests? And we'll see some examples of that. And then lastly, working capital cash flow. And so never say, oh, it's got good cash flow. Well, which of these cash flows is good? Because they're all very distinct and they're all measuring different aspects. Okay, now really good cash flow is you want all of these. Okay, but the great thing as analysts is you can learn that each one of these types of cash flows are telling us something else about the health or lack of health of the specific public company. So we can give you an example of where to look for attractive cash flow. Low capital expenditure, high operating returns, which is high profitability, negative working capital. Negative working capital, man, that's great. We own shares in a convenience store business in Thailand back in the I guess we bought it around 2004 and owned it for more than a decade. The faster it grew, the more cash it generated. What a beautiful thing that was. And incorrect depreciation policies. You know, just because depreciation, some company says depreciation is this, doesn't mean it's accurate. You've really got to look at what is the duration of their assets. So TSMC told me one time they depreciate over 4 years, their equipment. And I said, well, what do you do with the equipment after you depreciate it after 4 years? He says, oh, well, we've never taken any equipment out of operation. So, you know, to this day, I've never seen an analyst report that has studied TSMC's depreciation policy, but it's way too aggressive. And so they're understating their earnings, right? And so you can get these insights into companies by looking at their valuations. We invested in a textile company up in Korea. This guy was the mother of all depreciators. He did not like to pay taxes. So he built a $500 million petrochemical facility, 2 petrochemicals facilities back to back for $500 million. In 2.5 years, he depreciated the whole thing. Then he revalued it and depreciated again. So earnings were useless to this guy. He didn't care about earnings. He cared about cash flow, and he didn't want to pay the tax man. So the looking at these depreciation policies is really important. And again, they tell us so much. You can just see that Korean executive, right? What a different type of guy he was to the guy who depreciates the business that should be depreciated over 10 years and he depreciates it over 25 years. It goes right to the heart of who these people are and what they're trying to achieve. So when we talk about cash flow of the corporate structure, here is Samsung Group in Korea. And I defy anybody to really try to manage this structure honestly. 6 or 7 years ago, they tried to restructure some of this and it landed the owner's son in jail, and he's just gone back to jail. Because once you create this spaghetti, it's very hard to get out of it. Extremely hard to get out of it. You've got conflict of interest on every way you turn. And so what inevitably happens is you try to cheat. And eventually you're going to get caught and eventually you're going to put your boss in jail. Contrast that with Link REIT here in Hong Kong. Incredibly simple, 100% owned assets, all the cash flow can go up. And so if you look at Samsung, Samsung Electronics actually has cash and a pretty good cash flow asset business. But I can tell you a lot of these other Samsung Engineering, debt, no cash flow. And so they're going to require Samsung Electronics to support it some way. And that's where the conflicts come in. And that's where we as investors begin to lose money. Whereas in Link REIT, there's no wonder why we call Link REIT the best investment real estate company in Asia. Just simple, clean, neat. That's what we need. That's where we find our margin of safety. And then we talked about cash flow, the utilization of cash flow. So here are a couple of companies in Taiwan, and you see that the gross cash flow, the inflow, net income plus depreciation, going up, CapEx almost flat. And so what happens when you have that mix? Well, you get dividends. And so these guys have been terrific dividend payers to us for years and years and years, and been a stock in the portfolio for over 10 years. Wonderful, wonderful cash flow dynamics of the business. Again, TSMC, what you see if you go back further, you'll see more volatility. They've had periods where capital intensity of the business dropped and then dividends went up. And then we saw periods where capital intensity of the business goes up and the dividends slow. And the capital intensity goes down and then the dividends accelerate. And they're very purposeful about it. And when capital intensity goes up, these guys are so good that we know that the earnings are going to go up because the growth is going to accelerate. And that's what you're looking for, is you're looking for very purposeful management of the utilization of the free cash flow. And then you see guys that don't have any clue about this stuff, who just CapEx, CapEx, CapEx. And all that means is there's no free cash flow. And that means debt. So there's more debt on more debt on more debt. And of course, you never get a dividend. So how are we going to get our returns? So both of these companies are in a world and run by managements that they don't have an owner's mentality, and probably because they're getting money out of this business some other way. We're not being fair to us. So the being in here, these guys are right at the bottom of the pyramid that we talked about before. Then the last thing, the fourth point here we're going to talk about is the DuPont model. This is your way to really understand high profitability. And we used to talk, the DuPont model gets set up in the 60s, late 60s, early 70s. They're all focused on return on equity. We focus on operating return, which is a slightly higher up number with less distortion. Okay. But we've seen companies that have good returns on equity, high returns on equity for all the right reasons. And we have companies that have high returns on equity for all the wrong reasons. And maybe we could pose a question about what is an example of a high return on equity, which is for all the good reasons as opposed to bad reasons. Would anyone like to comment on that? And we could take a question or a comment or two, Ting Hing.
Yep, sure. Anyone? You can use the raise hand feature or type in the chat box.
If there are no questions, we can move on. I can talk a little more.
Yeah, I think we can move on for now.
So, but what we're talking about here is when you look at operating return, or you two companies with the same return on equity, one could get there by utilizing high leverage, and another one gets there by utilizing almost no leverage, but by earning superior margins and superior asset turnover. And that's what you're looking for. So the DuPont model is terrific to see as you get deeper and deeper into the DuPont model. And you can go to asset turnover. Then you can go to fixed asset turnover. Then you can go to receivable turnover and payable turnover and inventory turnover. You can get deeper and deeper, and you're gaining more and more insights into the company. And it's an enormously valuable tool that, my goodness, I first came across in the early 80s, and it has not outlived its usefulness. It's if you learn nothing else today, learn the DuPont model. And this is where we're talking about, right? We're trying to get to the top of the pyramid, but you don't want to get to the top of the pyramid with low quality return on equity. And that's where we go. We use a thing called operating return, which is EBIT over operating net assets. So we've taken out the cash, we've taken out the minority stakes. We're trying just to get to the factory. And so at Overlook, the operating return on a dollar-weighted basis throughout our portfolio would be about 40%. So if you have $1 billion invested in a business, that business is earning EBIT, not EBITDA, EBIT of 400 million. And we like companies that grow very modestly. We're not looking for high flyers. So 12 to 13% is where our sweet zone is. And so that billion, you got to figure they need to add about $130 million worth of additional net assets every year. But they're making 400 million. And so they have the money to finance their growth, and they have money to pay us in dividends. And when they do that, that's where you get your governance that you require. So I think this is a really important point. And then we just talked about trying to get sustainable self-funding EPS growth. If you have a company growing at 30, 35%, it better be enormously profitable, or it's going to have trouble sustaining and financing its growth, in which case it's going to have dilutive capital raising. It's going to have too much debt, too much interest expense, or they're going to be capitalizing on minority shareholders to raise additional equity and dilute the EPS. And we've decided in the trade-off between high returns and low growth versus high growth and low returns, we want high profitability and low growth. And it's a much safer way to do it. And so we find these sustainable growth companies with low cyclicality, high predictability, ability to increase market share and take market share from your competitors, large number of customers and suppliers, as we talked about. Low cost status is a great thing. A proven track record that we can see it, not over 3 years, but over 20 years. Bomb-proof balance sheets. At some point in your investing career, you're going to go through a 97, 98 bear market. And that's where you need. In bear market, balance sheets don't matter in good times, but they really matter in bear markets. And so the idea of again, we're talking about companies right at the top of the pyramid, that these strong businesses giving you that margin of safety. And if you look at Overlook, we have grown our EPS for 20 years at 12.5% on a dollar-weighted basis. We get an additional 3.2% for dividend yield, and re-rating or de-rating has contributed 1.5% per year. Not very much. Not very much. So Overlook is all about finding companies that can grow and have predictable EPS growth rates. And again, get up at the top of the pyramid, that's where those companies exist. And now the EPS growth, which leads to the DPS growth, that's been the driver of, we've grown the fund at 17.2% for just short of 20 years. And then we talked right at the beginning about the investment philosophy of Overlook Investments, and one was bargain valuations. You cannot ignore valuations. You just can't ignore them. And so we have found in the literature 3 equations, 2 we found in the literature, and then I invented one, which help us benchmark our portfolio. It's benchmarking. you can say absolute, but so much has happened. Ben Graham worked with his equations through the 60s and early 70s. John Neff worked on his equations in the 70s and 80s. I came up with my equation back in the 80s. And interest rate cycle, the interest rate levels are so different that these equations don't really work on an absolute level, but they certainly work on a relative basis. So if you have 20 to 22 stocks, who's scoring well on these equations and who's scoring badly? And it can give you insight because when you think about valuation, there are a couple of things you gotta really get right. Number one, you want to de-emotionalize the valuation process. Here in the United States, we have these shell company injections going on, and there's all this emotion in it, and it is going to end badly. And so how do you avoid those animal spirits overtaking your emotion? I find equations help. I find rebalancing also helps. You know, that these things push you in the right direction and help you particularly at these extremes of the cycle. So in total, what we've been focusing on here, and then we're going to open it up to a wider discussion where I hope everybody is able to contribute some questions, because I think out of questions, that's you're not only helping yourself, but you're helping your classmates. But what we're trying to do is we're getting this virtuous cycle that pricing power helps contribute to high profitability. High profitability helps to contribute to cash flow and sustainable EPS growth. And then we can take this focus that we have on valuations, and we're mixing all those things. We're being greedy that we want quality of the business, quality of the management, quality of the valuation, quality of the long term. We want all of that. And that creates what, in our view at Overlook, is this margin of safety.